Hey people, now you can't deny that when you look at the country's biggest banks, trading and speculation have become an ever bigger part of their businesses. But the financial crisis was not the result of information not being disclosed or too much trading. It was actually the product of an enormous credit bubble. Hey people, my name is Lewis, and I first got into banking when I was 17 years old. I worked for two of the biggest banks in America, in the country. At the time, I became completely obsessed with what was happening inside, not just here in Florida, but all across the country. These investors all around were handing out trillions of dollars in loans to massively overvalued assets. It was the most boring job I've ever had, but when I dug deeper, I learned the truth, and most of these loans went to people who were unlikely to ever repay them back. Your pre-approval process was definitely quicker. Some of the senior loan officers that I was mentored by, they all seemed to joke that if you could follow glass, you got a loan approval. So this bubble certainly made things worse by the spread of securitization, which pretty much means turning an asset, especially a loan, into what you call a marketable security, typically for the purpose of raising cash when they sell them to these investors. Now, this created an illusion that the risk was diversified, and it did make it easier for the lenders to hide the stack of crappy loans that were being funded and the credit default swaps, which allowed the banks to trick themselves that they were in fact insured against this risk. But the fundamental source of the crisis for these banks I worked for was massive amount of irresponsible lending. And while uncertainty did help fuel the panic in the fall of 2008, just like what's going on right now with this pandemic, which is not quite the same, but still very serious. For example, state officials have tried different ways to prevent property managers from booking their short-term rentals through Airbnb and other websites like booking.com. Imagine the pressure that these small business owners are feeling, as well as their families, because they rely on these short-term bookings to cover their mortgages and sometimes to pay their bills. For instance, fix and flippers have been frozen, many of their projects put on hold due to this virus, and most importantly, their capital and funds are tied. Now, side note to this, leverage. This market has shown me one thing: expect the unexpected. Using the bank's money is a great way to lower your risk. You see, cash is king. In my loans, I have been able to provide up to 100% financing. Now, the investors in popular tourist destinations like Miami and in remote rural communities, as people fled these hotspots, and urban cities like New York, they did see an increase in their inquiries and bookings. Although now, because of the unexpected increase in the numbers of reported cases, they were promptly banned by city councils, and pretty much with the fearful that the hospitals and the infrastructure would be overwhelmed by these outsiders. Year after year, we see these short-term rental reservations increase. Now for 2020, they are pretty much down to 75%. As for the builders, and many wholesalers and hardware stores are hurting as well. As for the majority of the factories and manufacturing plants across the country, all this equipment is parked due to the quarantine and the curfews for the workers who operate them. In some of America's biggest cities where construction and housing have been booming, digging in the ground right now is temporarily legal. So what I learned was bad loans were ultimately the problem, and they could be seen in the fact that the economists like Locks and Lukes wrote that of the 31 bank holding companies that failed and were seized by the US bank regulators, and this was between January 2007 and July 2009, loans and leases accounted for roughly 3/4 of their balance sheets, and trading assets essentially played no role. Now, at the height of the bubble, straight loans and leases constituted roughly for half of the bank's assets. The other piece of the pie was tradable assets, like what I do, mortgage-backed securities. Now, don't forget, they were no good. These ultimately derived their value from often worthless mortgages. It's like a sandwich of poop is still poop. Now, on a serious note, it was the housing bubble that was the source of the problem. So, in conclusion, People, the biggest issue with these banks that I worked for at those days was that they were funded almost entirely by debt. In other words, nearly all of their money that they lend out itself was borrowed. Now, this has a number of negative consequences. First, it consequences this purge behavior, since the banks are known for gambling with other people's money. Second, it means that the banks have very little cushion if they make mistakes, or if the unexpected happens, hint, right now. And since some of the biggest holders of bank debts are other banks, the heavy reliance on borrowing means that if one institution gets in trouble, its problems can easily cascade through the system, weakening the other banks as well. In my opinion, this is not the same as the mortgage meltdown that we once experienced, but more so temporary and unexpected market conditions. Remember, God bless the families and survivors, but before September 11, there were 22,000 residents in the lower Manhattan area. By the second quarter of 2006, there were 37,000 residents according to Downtown Alliance, which is a group dedicated to revitalizing this area called Ground Zero. Now, the commercial market also has rebounded. Many of the projects, or these big projects that are underway today, would not be there if they hadn't have been for 9/11. So have the right mindset and tune into more videos of value. If you found mine to be one of them, don't forget to smash the like button and subscribe to my channel for weekly videos on more sales strategies, real estate, and the most important thing, more mindset. Thanks for watching.